You ready? Do you agree?
Well, I think the front end of the market's priced for this, but I think
You get that language. If they get more hawkish, what happens to stocks? What happens to bonds?
Well, I think, Brian, both bonds and stocks will rally. I think that it'll show conviction on the part of the Fed that they're not going to allow inflation to take hold, and that'll be good for long-term interest rates, and I think we could get a pop in the bond market.
David, how do you think a quickened pace of rate hikes will play in the White House?
Well, I think they will probably try to not comment on it. At least I hope that's what they do.
Oh, really?
Well, we'll see. But they did avoid commenting in December when the Federal Reserve raised rates. They do find themselves in an awkward position. During the campaign season, the president complained that the Fed was keeping rates too low to help his opponent. So it would be difficult now to pivot around and say that the Fed now should keep rates low because of expanded fiscal policy. So, this will still be a slow tightening. If they go up 4 rate hikes this year, that's still very slow tightening, and I think the administration should probably try to keep out of this.
But only 60% of economists, according to our latest CNBC Fed survey, expect even 3 hikes this year, Karen. So if the Fed goes more, isn't there a fine line between being more hawkish than expected and being too hawkish, because that is not what the markets are expecting, and it's going to catch us off sides?
I think what you need to watch is financial conditions, the extent to which, as Scott was saying, the market might rally. The Fed doesn't want to be seen as too far behind the curve. They also don't want to get too far ahead of it, of course. So I think that they're happy to go a little faster. And if we think we're going to see 3 this year, even with the dot plot update, but it's possible you could get 4. We actually expect 4 for next year now. So they could be upgrading their pace. But it's really up to financial conditions. Are they going to be keeping up with the Fed, or are they going to be too slow?
1 minute and 11 seconds until the next announcement from the Fed. Scott, we had Jeff Gundlach on, and he says even when we're talking about short-term rates from the Fed, long-term rates, he doesn't think are going to budge very much.
No, I don't think so. I think long-term rates, the 30-year bond is already basically pricing for a full move to 3% in short-term rates in the next 3 years. And the 10-year note, I know we've had a lot of talk around this 261 level, Bill Gross's comments about the technical importance of it, but I think the real level in my mind is closer to 3, and our work shows that when we get short-term rates to 3%, that we'll probably be at the point of slowing the economy and inducing a recession. So I think the long end of the curve is fairly well priced, but we still are vulnerable in the 2 to 5 year area of the Treasury curve. And to Karen's point earlier, I think that we should be watching the dot plot. I'd like to see the dots move higher.
Scott, we're moments away on the Fed decision on interest rates. Let's get straight to Steve Liesman, as the S&P is up by 8 points right now. Steve.
The Federal Reserve raises interest rates by 25 basis points. .875. That's up from 0.625. The Fed says gradual increases in rates are expected, but no longer says that only gradual increases are expected. We can chew on that later. Neil Kashkari, the Minneapolis Fed president, did dissent, preferring to keep rates unchanged. Inflation, the Fed said, has moved up in recent quarters and is, quote, moving close to the Fed's goal of 2%. The Fed is forecasting 2 more rate hikes this year. It's forecasting 3 in 2018 and really 3.5 in 2019, bringing it up to 3%. So the longer run range is a very slight touch more hawkish on the long end. The Fed now hitting its terminal rate, or the final rate in this rate hiking cycle, or its long run rate of 3% in 2019, or the end of it. Previously, it was implied to be 2020. The median now is up an eighth for 2019 at 3% from 2.875. The near-term risks, the Fed says, are roughly balanced. Same as said last time around. The labor market continued to strengthen. Economic activity continues to expand at a moderate pace with solid job market, and the unemployment rate little changed in recent months, down near where the Fed is pretty much think the long run rate is right now. Household spending continued to rise moderately, and a pretty big change here, now saying business fixed investment firmed somewhat. For a long time, the Fed said that business fixed investment was soft. Let's see what else. The Fed left the growth forecast mostly unchanged, looking for 2.1% in 2017 and 2018, just up 1/10 for 2018, 1.9 for 2019, and then this is where it comes into conflict potentially with the Trump administration. It sees the long-run growth rate right now of the economy at 1.8%. Unemployment rate, 4.5% for the next 3 years is their forecast, and the long-run rate is 4.7. That's down 1/10. So once again, guys, a 1/4 point increase for the Federal Reserve up to that 0.875 middle range, or 3/4 to 1% is the new range for the Fed funds target rate, and forecasting 2 more rate hikes this year. Brian?
Well, yeah, just quickly before we go to Rick, Tyler, sorry to jump in. I noticed that I'm learning to love the dot plots, by the way, and the dot plots, and Steve hit on this, said the median went up. The dot plots did get a little more aggressive. We saw 7 now. Fed officials, guys, believe that we're going to be above 3% by 2019, up from 6, so a little more hawkish.
Right. The action in the bond market.
Let's go to
right?
Rick Santelli to see what happened in the bond market after this announcement. Rick?
You know, always fascinating. Everybody expected this. Many expect we're going to see more hikes. But the market moves are large. We are down 19 on the dollar index. We're now down 54. A second ago, we were down almost 2/3 of a cent, about 66 cents. Twos were at 139. I saw 133. It's stabilizing at 134. 211 and 10s. In 5s, we've lost 6 basis points. We're at 257 in 10s. We lost 4 basis points. And 30s hardly budge. They were at 313. They're at 312. One of the guests was pointing out the long end has a lot of channels to its pricing. But I think the dollar index gives us a real quandary to think about. That, first of all, and I'll leave this with Bob Pisani, stocks didn't lose any ground. How do you square all that? I think some of the issues of Europe and other central banks weigh in prominently, as does any legislation of the Trump and Trumponomics. But on its own, the market seems more than comfortable with what's going on, even though, of course, it priced a little aggressively. We call that the hurdle mentality. One of the hurdles is behind us. Now the press conference will be the hurdles ahead of us. Back to you.
Rick, thank you very much. Let's go to Bob Pisani, as money is coming into bonds at this hour. He's on the floor of the New York Stock Exchange. Bob?
Tyler, I think the way you square this, Rick was asking this question, the market going up, is that it essentially got what it wanted. Market was braced for a slightly more hawkish tone to the Fed. The key word was gradual. Okay, they removed the word only. That's not the key. Gradual, at least down here, gradual means 3 rate hikes this year. I polled everybody, and that's what they believe. If they would have implied 4 or even more, I think it would have been a problem. But as Steve's noted here, 2 more for 2017. That's exactly in line with what people were expected. Modest upgrade is something. That they have used, and more towards, well, we're going to start raising rates on a pretty regular basis. At least right now, the market seems very comfortable with that. Melissa, back to you.
Certainly does, Bob. Thank you very much. Let's run you through the markets and the reaction here. Going into this decision, the S&P 500 was up about 8 points. Right now, it has doubled its gain. It is higher by 0.7%. We are seeing some big reactions, as Bob had mentioned, in the bond market. Lots of money coming into the bond market right now. The TLT is higher by more than 1%. Interestingly, we're also seeing a big bid to some of the interest rate-related areas of the market. Utilities, for instance, hitting a session high here. We are seeing some pullback in the financials. Let's bring back our all-star Fed panel here. Scott Minerd, Global CIO with Guggenheim Partners. David Kelly, Chief Global Strategist with JP Morgan Funds. Karen Kimbrough, Head of Investment Strategy for Merrill Lynch Wealth Management. Steve Leisman, of course, standing by there as well. Scott, I want to go to you here. We see the action in the bond market is a very interesting move, considering the market got exactly what it wanted. And this is certainly hurting a lot of those hedge funds that are positioned very strongly to be short bonds right now.
Well, and I think that's going to give us a pretty good footing for bonds here over the next week or two. A lot of people have been offside here. There was heavy shorting in the last week or two, and now that the market is rallying, it's going to cause some pain, and the pain trade should support bonds for the coming week, I think.
Karen, why are people buying both stocks and bonds in the wake of this announcement?
They were probably a little too conservative on the bond side, ready for that really big sell-off. As Scott mentioned, we ended up sort of seeing a bit of a rally there. And I think also you've got this idea that the Fed is not going to kind of precipitate any kind of recession. They're not going to go too fast, but they're starting to get their groove. They're going to start raising. They've told us they're going to do what the market was pretty much expecting. This is the best of all possible worlds.
So that's the stock response.
This is the best of all possible worlds.
And Scott, listen, I think the viewers know that we're friends, but I will say, hey, you called it. 2 minutes before the Fed thing, you said both stocks and bonds were going to go up, and you got it exactly right.
Hey, Brian?
Yeah.
Yeah, I just wonder how much the market believes the Fed once you get beyond this year. And maybe Scott has a feel for that. I don't think if the short end of the curve is going to 3 in 2019, that the 10-year belongs here at 258. I think there's a trust but verify thing going on here where the market is ready to believe the Fed to the end of 2017, maybe a piece of 2018. But much more than that, there's a split as we go down the river where the Fed, where the market is priced and where the Fed is forecasting right now.
Well, that's probably why we saw Fed funds futures. I mean, up until this rate meeting, right, we saw extreme skepticism on the part of the markets until just a couple of weeks beforehand. And I think, Steve, you're right on in that.
Yeah.
In that it sort of, you hear the language and it makes them believe that, but we'll believe it when we believe it.
Yeah.
Well, I also
Scott,
think
let me go back to you, by the way. Good call. Congrats on that. Your clients are probably happy. And I don't want to say dot plots again because I hate saying it and it confuses people. But as I'm going to tweet out in a few minutes a picture, we went from 7 Fed dots, Fed people, their outlook, in 2018 who were below 2% to just 3. So we talked about the much longer term, but we're talking next year. How much more hawkish, Scott, based on those projections, do you think this Fed really got today?
Well, I think the Fed did a gradual upgrading in its expectations on growth. And it left the door open for the prospect that if it needs to, it can pick up the pace of tightening. And I think that gives the market the confidence I was talking about earlier that they're not going to let inflation run out of control and they're going to try to stay on course. If they see unexpected rises in inflation or continued declines in unemployment, that they'll continue to gradually upgrade their expectations, which will lead to a faster rate of increases.
David,
I think that's the plan.
The Dow was up 100 points. It's pulled off of that, still up 86, but a very positive reaction in stocks. You heard explanation from Karen. Does that make sense to you?
Yeah, I mean, I think there's a lot of money that is. I think there's a lot of optimism. I think this says that the Fed remains dovish, and I do believe, by the way, it is very dovish. I mean, if you think about this objectively, if you look at these long-term forecasts that Steve Liesman was talking about, we've hit all of them. We're there right now on growth. We're there right now on inflation. We're there right now on unemployment. But the Fed is about 2 years or more away from its long-term target on the federal funds rate. You know, the idea is you're supposed to take away the punch bowl when the party's in full swing. Right now, this is a party unsupervised. The Fed isn't going to arrive for about 2 years to actually get rates to the level appropriate for where the economy is right now. So there still is a danger of overheating here.
It would be absolutely uncharacteristic for this Fed under Chair Yellen to raise by a half point. Do you think they ever could, David? Or should they?
No, I don't really think they should. I think that would be, because it would be uncharacteristic, it would be destabilizing to markets. But I think they should raise it every non-crisis meeting they have this year. You know, three rate hikes is an odd number. Because
press availability, right? I mean, who needs that?
Hey, Tyler, I just want to underscore what Scott just said. I think the removal of that word "only" is the Fed saying, hey, if we need to go 50, we will. I think it's a slightly different question what you asked David, which is, will they? But I think of the question of can they, that's what they did here, is they left themselves the possibility of being a bit more aggressive.
But they don't have to do that. They could simply just go at other non-press conference meetings, as you're saying. I think 50 is more of an adrenaline shot. I think they could just start going more frequently, and they would have 8 times a year to do that.
Scott, I'm a little soft here. If I could ask you a question. The market is higher. Stock market is definitely higher. Bonds seem to be rallying as well, so interest rates are going down. Financials are getting hit. If you look at the intraday chart of the financials, people there are losing money if they own Goldman Sachs or JP Morgan, et cetera. I still don't quite understand what the market is telling me in the wake of this announcement.
Well, I think the idea that the Fed is allowing or acknowledging sort of this gradual improvement in the economy is telling us that stocks earnings are probably solid. But the performance we're seeing in financials doesn't surprise me, because the big banks like Bank of America, who has a very stable deposit base and whose deposit costs are not sensitive to the short-term movement in rates, really need a steeper yield curve in order, or higher rates in order to make money off of that deposit base. So as rates are coming down, it's impacting their earnings adversely. And so I'm not surprised to see financials sell off when you see a bond market rally like this today.
David, at the same time, we're seeing the interest rate sensitive sectors like utilities and real estate. They are rallying. They're at session highs right now. Is this an all clear for those kinds of defensive investments? And do you want to be positioned like that in a market which the Fed is signaling, the economy is strong?
No, I think this may be a bit of a head fake for people in those positions. Obviously, when the yield curve flattens, as Scott said, you're going to see financials get hurt and things like utilities and REITs get helped because they're so interest sensitive to the long end of the yield curve. The thing is that the Fed relentlessly gives us these 1/4 point moves. Our statistical analysis suggests that no matter what people think at this point, that relentless move up in the short rate does tend to push long rates higher, and that should help the financials and it should hurt the utilities and the REITs.
With all due respect to the Fed, Karen, and guys, can we bring up, this is called producing my chair, the XLF financial ETF, if you haven't already, because while the Fed and interest rates are important to financials, if you look at the best team in the business, thank you. If you, can we do a 1 year? The biggest move in the financials came November 4th, right before the election. I think, what do you think, that there's maybe more of a Dodd-Frank repeal or whatever aspect to the bank move than the Fed? What do you think?
So first of all, I think you never know until Janet Yellen has spoken, and that's still to come, right, today. So I think there are some people who are probably going to wait to make a move until after that. I think secondly, yeah, absolutely. There is a sense that a lot of the lighter touch on the regulatory side will be helpful to banks. Much more important, perhaps, than whether or not we get a 1/4 point here or a 1/4 point there. But we know the Fed is going to keep hiking. They've told us that. We thought maybe the pace would be a little faster than it was. But there's no reason to think that for any reason it won't still keep going up. So I think all of this is banks positive.
Guys, Brian, one of the things. Sorry, I said, Brian, one of the things that you always say to me, or you say to us on the panel, how do you make money from this? Clearly, Karen's comments about regulatory reform, clearly the trend in rising interest rates. It's time to be buying these bank stocks, even after they've moved so much. I think that we have a pretty clear trajectory for higher prices in banks.
All right, we got to go, guys. Thank you so much for this analysis, Scott, David, and Karen. Of course, our thanks to Steve Gleason for going through this statement. We'll see you in a little bit.
If that wasn't enough for you, here's what else is coming up on Power Lunch. We're going to get reaction to the Fed decision from legendary investor Bill Gross. Then you hear from Chair Yellen herself. The Fed's post-decision news conference is live and straight ahead here on Power. Plus, a big jump in home builder sentiment that's the highest since before the housing crash. Is it a Trump bump? Don't go anywhere. Yellen's news conference is 15 minutes away. Power Lunch back in 2 minutes.